A very common beginner question is this: which time frame is best for trading? The answer depends on your experience and mindset. But for beginners, some time frames work better than others. Let's keep this simple. Lower time frames move very fast. Prices change quickly and randomly. This makes them stressful for beginners. Small moves can trigger emotional decisions. This often leads to overtrading. Higher time frames move much slower. They show clearer trends and structure. This makes analysis easier and reduces emotional pressure. For most beginners, higher time frames are better, such as the 1-hour or 4-hour chart. These charts give you time to think. You don't need to watch the screen all day. Daily charts are also good for learning. They remove most market noise and help you focus on the bigger picture. The goal is not fast profits. The goal is consistency and discipline. Many beginners choose low time frames for excitement. But excitement usually leads to mistakes. Trading should feel calm, not rushed. One good time frame is better than many random ones. Stick to one main chart at the start. Learn how price behaves on it. As you gain experience, you can adjust. But there is no rush. Good trading is about patience, not speed. Quick recap. Lower time frames are fast and emotional. Higher time frames are calm and clear. Beginners should start with higher time frames. Focus on learning, not rushing. This builds strong trading habits. In the next video, we'll talk about multi-time frame analysis basics.